If you had put $1,000 into Amazon decades ago and simply forgotten about it, you would likely be sitting on a number large enough to make ordinary people speak to you differently. That is the fantasy that poisons most investors. They look backward, find the one rocket ship that survived history, and then they convince themselves that wealth is mainly a matter of spotting the next miracle before everyone else does. That is not investing. That is lottery thinking wrapped in hindsight. And hindsight is the most dangerous salesman in finance because it always arrives after the risk is gone. I have watched people spend years hunting for the next Amazon, the next Apple, the next Nvidia, the next impossible stock that will save them from the slow discipline of ordinary wealth building. Most of them do not become rich. Most of them become emotional. They become obsessive. They become half analysts and half gamblers. They spend their evenings reading rumors, their mornings checking prices, and their weekends telling themselves that one big winner will make all the waiting worthwhile. Meanwhile, the people who actually become quietly rich are usually doing something far less exciting. They stop trying to predict the next great company. They start buying the machine that keeps producing them. That is the line I want you to sit with, not the next winner. The machine that keeps producing winners, because the real secret of wealth in markets is not that a handful of companies become enormous. Everyone knows that already. The real secret is that systems can be built to capture those winners automatically while ejecting the losers before they can destroy you. That is what a proper ETF does for an ordinary investor. And once you understand that, the whole game changes. You stop asking, what stock should I pick? You start asking, what engine should I own? That is the adult question. A stock is a story, an engine is a system. Stories can seduce you, systems can enrich you. Most people never get rich in markets because they are in love with stories. They want the drama of being right early. They want the bragging rights of naming the company before the crowd noticed it. They want their intelligence flattered. They do not want to admit that they could become wealthy in a more boring way than their ego prefers. But wealth does not care how flattering the method is. Wealth cares whether the method survives. That is why I have always respected broad ownership more than brilliance performed in public. Now I want to take you into the deeper truth underneath these three ETFs, because the mistake people make is they think these are just products. They are not. They are roles. They are functions. They are different forms of ownership with different jobs inside a life. And once you see the jobs clearly, you stop treating investing like a collection of tickers and start treating it like architecture. The first job is broad ownership of productive America. The second is ownership of businesses that turn profit into rising cash flow. The third is ownership of innovation and velocity, with all the volatility that comes attached. And above all three sits the most important job of all, which is not picking, not timing, not predicting, but continuously buying when your emotions would rather wait. That is the part most people miss. The ETF is the tool, the system is the weapon. Let me begin with the first one. When I look at something like VU, I do not see a ticker. I see organized surrender to the fact that I do not need to be the smartest man in the room to get rich. And that is a very profitable realization. The ordinary investor makes his first great mistake when he assumes intelligence in markets means precision. It often does not. Sometimes the highest form of intelligence in markets is broad acceptance of how little precision is actually required to win over a long enough timeline. VO gives you ownership in the SP 500, which means you are not trying to identify the next single business that will dominate the future. You are buying the largest productive muscle inside the American corporate system that matters more than people think. Because America, for all its political madness and cultural noise, still has one extraordinary economic trait. It keeps manufacturing giant companies, it keeps generating scale, it keeps producing institutions that take over categories, industries, and global demand streams. If you own the largest 500 public companies, you are not betting on one story, you are buying the empire's current operating core. And here is what makes this structure so powerful. The fund does not love any one company. That is a gift. Human beings get attached, systems do not. When a giant company weakens, stumbles, or dies, the index eventually removes it and replaces it with something stronger. That process is one of the most underappreciated miracles in investing. The investor thinks he is buying a list. In reality, he is buying a self-renewing filter. That is the first mechanism. I call it the survival filter. If you bought Sears because it looked permanent, history punished you. If you owned the broad market, history quietly moved on without asking your permission. The weak were removed. The stronger firms took their place. You did not need to predict which company would fail. The system handled it for you. That is why broad indexing is so much more powerful than people realize. It is not just diversification. It is automatic Darwinism. And Darwinism with low fees is one of the most efficient wealth machines ever handed to ordinary people. Now think about what that means psychologically. You are sitting in some lifeless meeting at work while companies you do not manage, in cities you will never visit, are selling burgers, chips, pharmaceuticals, cloud software, industrial equipment, payment services, insurance, beverages, devices, and pieces of the modern world to billions of people. If you own the index, a microscopic sliver of that productive activity is working on your behalf. That is what I mean when I say broad ownership is more important than stock picking for most people. You stop needing to be clairvoyant. You become a tax collector on human productivity. That is a much better business. The second job inside a serious ETF portfolio is different. It is not broad participation in everything. It is selective ownership of businesses disciplined enough to share profits with owners in rising streams. That is what draws me to something like SCHD. Most people misunderstand dividends in one of two ways. The unsophisticated ignore them because they think only price appreciation matters. The equally unsophisticated chase them because they think the highest yield must be the smartest move. Both camps are wrong. Dividends are not magic. Dividends are not a substitute for business quality. A weak company can pay a seductive dividend right until it cannot. And then the investor discovers he did not buy income at all. He bought a temporary promise strapped to a deteriorating enterprise. That is why yield by itself is a trap. The real question is never, how much does it pay today? The real question is, what kind of business is capable of paying me more tomorrow without injuring itself? That is the second mechanism. I call it the rising paycheck test. A strong dividend company is not just writing you a check. It is demonstrating that its underlying profit engine is durable enough to reward owners regularly while still surviving competition, inflation, recessions, and management stupidity. When I look at companies inside a dividend growth ETF, what matters to me is not merely that they pay. What matters is what kind of businesses they are. Toothpaste, drinks, medical products, semiconductors in mature categories, basic consumer necessities, industrial systems, energy majors, services people keep buying through all kinds of weather. This is not the glamorous side of capitalism. That is exactly why it is useful. People love to talk about tomorrow's miracle, but most fortunes are financed by today's repetition. A company that sells something people buy in recessions and expansions, in fear and comfort, in bullish years and miserable ones, has a very different psychological profile than a company valued almost entirely on some dream of future dominance. That is why a dividend growth ETF can do a job broad growth exposure cannot. It converts part of your portfolio from pure appreciation hope into a rising cash engine. And a rising cash engine matters far more than people realize, especially as your portfolio gets bigger. A worker depends on wages. An owner eventually depends on distributions. That transition is one of the most important identity shifts in money. As long as you think only in terms of salary and price appreciation, you are still mentally trapped in accumulation mode. Once you start understanding how ownership can generate a stream, your relationship with money changes. You stop thinking only about what your portfolio is worth. You begin thinking about what your portfolio can throw off without being dismantled. That is adulthood in investing. Now, I want to be very clear. A dividend ETF is not there to make your life exciting. It is there to bring stability of character into the portfolio. It says, in effect, I do not need every company in here to change the future. I need these companies to keep making money from the ordinary habits of civilization and to keep handing some of that money back to me. That is a beautiful arrangement. And when those payouts grow over time, something subtle happens. The cash flow itself begins compounding your calm. Because income coming out of a portfolio changes the emotional burden of ownership, it makes the market feel less like a scoreboard and more like a farm. The scoreboard mindset is fragile because it only feels good when prices rise. The farm mindset is stronger because the farm is still a farm, even in bad weather. The yield is still there, the ownership still matters, the process still produces. That is why I respect cash-generating businesses so much. Now we come to the third job, acceleration. That is what something like QQQ represents. And this is where weak minds tend to get hurt. Because they hear the words higher returns and forget to ask what must be endured to earn them. QQQ is not the broad American machine. It is not the dividend machine. It is concentrated velocity. You are buying the largest non-financial companies on the NASDAQ. In practice, that means a heavy relationship with technology, with platforms, with software, with the dominant digital architecture of the modern economy. There is a reason this has created enormous wealth over the right stretches of time. Technological leverage is different from ordinary business leverage. Once a firm reaches scale in software, data, semiconductors, cloud infrastructure, operating systems, or certain network-driven categories, the economics can become outrageous. The winners can grow faster, wider, and more profitably than traditional industrial businesses. But there is a price for access to that engine volatility, and most people say they can handle volatility right up until they meet it. That is why I say QQQ is not just an ETF. It is a temperament test. You do not earn those stronger long-run returns for free. You earn them by holding something that can humiliate you for months or years if you are emotionally unprepared in the dot-com collapse. Technology-heavy indexes were crushed. That pain was real. It was not theoretical. If you owned innovation at the wrong price and lacked emotional structure, you got destroyed. That is the third mechanism. I call it the pain premium. Markets do not hand out excess returns because they are feeling charitable. They hand them out because most people cannot survive the ride required to collect them. If you want the upside of innovation, you must be able to remain seated when everyone around you is screaming that the future is over. That is hard. And because it is hard, it pays. The average person should never buy QQQ because he heard it has better historical returns. That is exactly the wrong reason. He should only own it if he understands what it is for. It is not there to replace discipline. It is there to reward discipline. If you cannot hold through a 30%, 40%, or even larger drawdown without rewriting your philosophy in the middle of the storm, then a growth-heavy ETF will not make you rich. It will simply expose how unstable your process was all along. That is why I do not think in terms of the best ETF. That is amateur language. I think in terms of the job each ETF is performing inside the overall machine. BOO gives you the broad operating system. SCHD gives you the cash machine built on business quality. QQQ gives you innovation acceleration if you are emotionally equipped to hold it. Now, if this were merely a matter of choosing the right ingredients, everyone would eventually become rich. They do not. Because the real edge is not in knowing the ingredients, it is in building the purchase protocol. This is where most people lose. They spend all their time asking, what should I buy? They should be asking, what system will keep me buying when my emotions are trying to save me from the very thing that will make me rich? That is the fourth mechanism. I call it the always. Buying discipline. The biggest mistake ordinary investors make is treating each market move like a referendum on whether they should continue participating. The market drops and they become philosophical. The market rises and they become enthusiastic. The market moves sideways and they become bored. Their entire financial future gets negotiated one emotional weather pattern at a time. That is no way to build wealth. If your horizon is 10, 20, or 30 years, then what the market does in the next 3 months should not be emotionally dominant in your process. I did not say irrelevant. I said not dominant. Because short-term turbulence is not a threat to the long-term investor who is still in accumulation mode. It is inventory repricing. That is all. A market decline means the same dollars buy more ownership. That is not a tragedy. If your paycheck is still coming in and your process is intact, it is a discount. The way you make that truth useful is to automate it before your feelings can interfere. Always be buying, not because slogans are cute, because consistency is stronger than prediction. You buy when the market is high, you buy when it is low, you buy when the headlines are frightening, you buy when everyone feels invincible, you buy when a Republican is in office, you buy when a Democrat is in office, you buy when oil spikes, you buy when rates fall, you buy on Wednesday if you chose Wednesday, and then you shut up and continue buying on Wednesday whether the week felt good or not. That is how adults do it. The retail investor destroys himself by waiting for perfect entry. He tells himself he is being prudent. In reality, he is asking the future for emotional certainty before he acts. The future never gives that. The best opportunities often feel worst in real time. That is why waiting for comfort is so expensive. I have watched this pattern over and over. A crash comes. The market falls hard. Intelligent-sounding people begin explaining why things will get much worse. They may even be right in the short run, but while they are narrating disaster, something more important is happening. The price of future ownership is being marked down. The disciplined buyer keeps buying, the frightened spectator keeps waiting, then policy shifts, liquidity arrives, fear recedes. And the market begins climbing long before the waiting man feels safe enough to return. By the time he feels safe, the discount is gone. This has happened so many times that I no longer consider it an exception. It is one of the defining habits of the crowd. The crowd wants proof first and price second. The wealthy learn to prefer price first and proof later. That is what always buying really means. It does not mean being stupid. It does not mean ignoring valuation or pretending every asset is equally attractive at every moment. It means your core behavior must not depend on emotional weather. Your process is your moat. And once that process exists, something remarkable happens. The market stops feeling like a series of traps and starts feeling like a supplier. High prices mean your existing inventory is worth more. Lower prices mean new inventory is cheaper. Both conditions can be useful if you understand your role. You are not here to be entertained. You are here to accumulate ownership. That is the final identity shift. Most people think they are investors because they own securities. Most people are still spectators with accounts. A real investor is somebody whose behavior is stable enough to let time do the heavy lifting. He does not need to be right every month. He needs to remain in the machine long enough for compounding to become undeniable. Now let me take all of this and compress it into one picture. Imagine your portfolio as a city. VU is the broad foundation, the roads, the utilities. The entire economic grid, SCHD, is the set of mature cash generating businesses that pay the city to keep functioning. QQQ is the fast-growing technology district that occasionally terrifies everyone but keeps pulling the whole future forward. And your automated purchase plan is the labor force that keeps building all of it, regardless of mood. That is how you create millionaires. Not by naming one future hero, by owning the civilization that keeps producing them. That is why these kinds of ETFs have created more ordinary millionaires than almost any single stock ever will. Not because any one of them is magical, but because together they solve the three great problems that ruin ordinary investors. The first problem is selection risk. Most people will never correctly identify the next giant before the market notices it. The second problem is concentration risk. Even when they do identify something promising, they lack the discipline to size it properly and survive the drawdowns. The third problem is behavioral risk. They do not have a purchase protocol strong enough to keep them invested and accumulating through fear. A proper ETF structure attacks all three. Broad exposure reduces selection risk. Diversified baskets reduce concentration risk. Automation reduces behavioral risk. That is why this works. It is not because ETFs are trendy. It is because they transform weakness in human nature into something survivable. They admit that most people are not master stock pickers. They admit that most people are not emotionally built for concentrated bets. They admit that most people need a system stronger than their moods. That is not pessimism. That is intelligent design. And intelligent design of behavior is one of the highest return activities in finance. Now let me leave you with the part that matters most. The millionaires created by these ETFs are not created because the ETFs are extraordinary. They are created because ordinary people finally adopt extraordinary consistency. That is the truth almost no one wants to hear. The ticket was available. The difficulty was never access. The difficulty was staying ordinary enough to let the system work, to keep buying when it felt boring, to keep buying when it felt scary, to keep buying when everyone else wanted a more dramatic story, to keep buying when your friends were chasing the next hot stock and calling you too simple, to keep buying when the market gave you no applause. That is how wealth is really built, not by genius, by disciplined ownership applied for longer than your ego thinks is reasonable. So if you want the cleanest version of the answer, here it is. VU teaches you to own the winners without needing to name them. SCHD teaches you to respect quality and rising cash flow instead of flashy yield. QQ teaches you that the future can be owned, but only by people who can tolerate the paying premium. And always buying teaches you the only habit that makes all three work. That is the system. That is the machine. That is how more millionaires are made than any single stock will ever create for ordinary people. The great wealth building trick is not finding one miracle. It is building a process that survives your own need for miracles. Once you do that, time stops being your enemy. It starts becoming your employee. And that is the closest thing to financial magic I have ever seen.